Hi, this is Scott CPA again. Today we're talking about a frequent error by taxpayers, ignoring inherited assets. Before we begin, I want you to draw your attention to the two buttons on my blog. Click here for a free tax relief consultation, or click here to view my free tax resource library. Back to our topic of the day. Ignoring inherited assets. When a person inherits stocks or other assets, they often believe they are not taxed. This is partially true. These assets are not taxed when received, but when these assets are later sold, a person must report the sale on their tax return. I've had many cases where ignoring these sales causes tax notices with huge taxes, penalties, and interest that surprises and scares the taxpayer. Since inherited assets receive a step-up in basis or tax cost, there is often very little gain or loss. There would be little, if any, tax effect if a sale occurs quickly after inheriting these assets and it is reported correctly. To correct this problem and eliminate these surprise taxes, we must amend the original tax return that ignored the sale and provide evidence of death of the person receiving the stock ownership statements showing the history of previous ownership, and receipt and eventual sale. I have had several cases where in the end there is very little tax effect. Time and fees to professional to amend a tax return is expensive. A taxpayer can save themselves a lot of grief and cost by understanding that any asset they inherit and later sell must be reported on their tax return. If you have tax problems, you should protect yourself by hiring a qualified tax problem specialist. We have experience in the strategies in negotiating with the IRS to get you the lowest amount that you have to pay. My contact information is below. If you have a tax problem or know someone with a tax problem, please share this video or contact me. Until next time, look forward to hearing from you. Thanks again.